Something broke in this market, not the protocol, not the infrastructure, not the thesis that serious investors spent years building their conviction around. What broke was the narrative. And when narratives break at this speed, in this environment, the noise becomes so loud that the signal disappears entirely. That is exactly what has happened. While social media has spent the last several weeks oscillating between panic and denial, while headlines have cycled through the same fear-driven vocabulary they use every single time this asset corrects, something far more important has been unfolding quietly underneath the surface. In the derivatives markets, in the ETF flow data, in the on-chain accumulation patterns, in the boardrooms of institutional allocators who do not post about their positioning on the internet. Most people watching this market right now are reading the wrong data, not because they lack intelligence, because they are looking at price when they should be looking at structure. They are measuring sentiment when they should be measuring mechanics. They are reacting to what the market feels like when the only thing that actually matters is what it is doing. Most misunderstood setup in markets. And right now, today, February 22nd, 2026, you are sitting inside it. So let's talk about what is actually happening. Not what it feels like, what the data says. First, I want to acknowledge something directly. If you bought Bitcoin anywhere near the October 2025 high, anywhere in that $110,000 to $126,000 range, you are sitting on a drawdown that by any objective measure is painful. Not painful in a theoretical portfolio management sense. Painful in the way that real money disappearing from a real account creates a real feeling in your chest every morning when you look at your phone. I am not going to minimize that. Minimizing it would be dishonest, and dishonesty in this market has caused more damage than any correction ever has. What I want to offer instead is clarity, because right now in this exact environment, clarity is the rarest and most valuable thing available. The headlines are loud, the fear is real. The social media discourse has inverted from euphoria to doom with the same confidence and zero additional information. And inside all of that noise, there is a structural story happening that most people watching price charts are completely missing. Let me give you the actual numbers as they stand today, because precision matters more than comfort when you are trying to understand a market. Bitcoin hit an all-time high of $126,000 in October 2025. It fell to a low of approximately $60,060 in early February 2026, a drawdown exceeding 52% from the peak. It has since partially recovered, consolidating in the $66,000 to $70,000 range, where it trades today. The 24-hour trading range as of this morning sits between $66,524 and $68,300. The market capitalization stands at approximately $1.36 trillion. The Fear and Greed Index, which aggregates sentiment data from multiple market signals, currently reads 13 out of 100. That places it firmly inside what the index classifies as extreme fear territory. For context, similar readings appeared during the FTX collapse in November 2022. Google searches for the phrase Bitcoin Zero hit a record high in the United States in February as Bitcoin slid towards $60,000, according to CoinDesk. The same search spike pattern appeared in 2021 and 2022, both of which coincided with local market bottoms in retrospect. Not predictions, patterns. Now here is the data point that received almost no mainstream attention. Bitcoin is down more than 20% year-to-date in 2026, making it one of the weakest major asset classes to open the year, while global equity indices are printing new highs. The S&P 500 sits above 6,900, the Nasdaq above 22,800. Bitcoin is moving in the opposite direction from traditional markets that are broadly positive. That divergence is not random. It has a specific structural explanation, and understanding it changes everything about how you interpret this moment. To understand why Bitcoin is falling while equities rise, you have to understand how institutional risk management actually functions. Not the simplified version, the real version. Large institutional participants, pension funds, asset managers, family offices, hedge funds, operate within what are called risk budgets. These are not emotional limits. They are quantitative constraints embedded in their investment mandates. When volatility in a specific asset rises beyond a defined threshold, exposure to that asset must be reduced. Not because a human decided it, because the risk model demanded it. Bitcoin's realized volatility has spiked significantly during this correction. When that happens, risk management systems at institutions automatically calculate that Bitcoin now consumes a larger portion of their total portfolio risk budget, even if the dollar allocation has not changed. The only way to bring portfolio risk back within mandate is to reduce the Bitcoin position. That selling is mechanical. It is not a statement of conviction. It is not a fundamental thesis change. It is a risk management protocol executing automatically. Simultaneously, consider what has happened at the macro level since October. The Trump administration nominated Kevin Warsh to replace Jerome Powell as Federal Reserve Chair. Warsh is perceived as significantly more hawkish, more willing to keep rates higher for longer, less likely to provide the liquidity accommodation that risk assets depend on. That single nomination, regardless of when it takes effect, shifted the forward rate expectation curve. Longer rates for longer means tighter financial conditions for longer, and in tighter financial conditions, the first assets to get reduced are the highest beta, highest volatility instruments in an institutional portfolio. That is Bitcoin. Then there is private credit. CoinDesk reported this week that Blockfills, a Chicago-based crypto lender, is exploring a sale after sustaining a $75 million lending loss during the recent price crash and temporarily suspending client deposits and withdrawals. Cracks from the correction are surfacing in credit markets. When credit stress appears, it adds another layer of risk-off pressure on top of the price pressure. Institutions that might otherwise hold through volatility become more cautious when they see credit events emerging in adjacent markets. Add to that, White House hosted talks between crypto industry representatives and traditional bankers on the digital asset market structure bill, while showing incremental progress, have not yet produced a compromise. Regulatory clarity that could unlock the next wave of institutional inflows remains pending. In the absence of that clarity, the path of least resistance for institutional capital during stress is to reduce rather than increase exposure. This is the full picture behind the numbers. Not panic, not fundamental failure, systematic, mechanical, mandated risk reduction across multiple institutional categories simultaneously. Understanding that reframes the entire conversation. The ETF flow data tells this story in precise terms, and I want to walk through it carefully because it is the most misread data set in crypto right now. US spot Bitcoin ETFs have now recorded 5 consecutive weeks of net outflows, the longest outflow streak in nearly a year. Last week alone, $315.8 million exited the funds. On February 19th, IBIT, BlackRock's iShares Bitcoin Trust, recorded $164.1 million in single-day outflows, accounting for virtually all of that session's negative flow. Year to date, over $4.1 billion has been withdrawn from crypto ETFs, with Bitcoin-focused products leading the redemptions. IBIT, which attracted $24.9 billion in net creations throughout all of 2025, has given back a meaningful portion of those flows in the first 6 weeks of 2026. Those numbers, read in isolation, sound catastrophic. But read in context, they tell a more nuanced story. The average cost basis for US spot Bitcoin ETF holders is estimated at approximately $90,200 per coin. With Bitcoin trading in the high 60,000s, the average ETF investor is underwater. When the average holder is losing money, redemption pressure is mechanical. It does not require a change of thesis. It requires only that the pain of holding exceeds the conviction of the original purchase. That threshold varies by investor. But when enough investors cross it simultaneously, the flows become self-reinforcing. Here is what most coverage ignores. Within the same 5-week period that Bitcoin and Ethereum ETFs have been losing assets, Solana ETFs recorded net inflows. XRP-linked products drew positive flows. Capital is rotating within the crypto asset class, not leaving it entirely. This is a selective repositioning, not a wholesale abandonment. Investors are moving from Bitcoin to crypto assets they perceive as having distinct catalysts or relative value. That is a materially different signal than total crypto market exit. And on February 20th, just 2 days ago, BlackRock's IBIT led a brief $88 million day of net inflows after 3 consecutive days of selling. One day does not establish a trend, but it establishes that the buyers have not disappeared. They are waiting for conditions to stabilize before re-engaging at scale. Now let's look at the on-chain layer, because this is where the structural signal sits underneath the noise of price and flows. Data published by CoinDesk on February 21st shows that Bitcoin wallets holding less than 0.1 BTC, the retail shrimp category, have increased their share of total Bitcoin supply to the highest level since mid-2024. These small holders are buying the fear. They are accumulating as price sits in the mid-60,000s. That is not a sophisticated institutional signal, but it establishes a demand floor that absorbs selling pressure and prevents the kind of complete price vacuum that characterizes true structural collapses. Simultaneously, the wallets in the 10 to 10,000 Bitcoin range, the category that includes whales and significant institutional holders, who have historically driven major directional moves, have been reducing their positions since the October peak. They accumulated through the run-up. They distributed into the euphoria above $100,000. They have not yet resumed accumulation at scale in the current price range. That divergence, retail buying, whales still distributing, tells you something important about where we are in the transfer process. The deleveraging is not complete. The large holders who exited above $100,000 have not yet decided that current prices are attractive enough to rebuild their positions. When that decision changes, when on-chain data shows whales and significant holders resuming accumulation, that will be the structural signal that precedes the next directional move. We are not there yet, but we are watching for it. Crypto derivatives traders, according to CoinDesk's February 19th reporting, are currently buying downside protection aggressively, Wintermute's head of OTC noted that puts are trading at steep premiums to calls, meaning sophisticated participants are paying significantly more to hedge against further downside than to express upside conviction. That positioning, while it looks bearish in isolation, is also a sentiment extreme. When everyone has already bought their insurance, the marginal seller has already sold. The incremental force driving price lower diminishes. I want to address the comparison to history with the intellectual honesty it deserves, without using it as false comfort. In 2017, Bitcoin ran from approximately $1,000 to $20,000, then fell more than 80%. The dominant narrative was that it was a speculative bubble that had conclusively ended. In March 2020, Bitcoin fell roughly 60% in 2 weeks during the COVID crash. It felt structurally catastrophic. In 2022, after peaking near $69,000, it fell more than 75% to approximately $15,000 amid the FTX collapse. In every instance, the narrative at the bottom characterized the fall as permanent rather than cyclical. The current drawdown, from $126,000 to a low of 60,062s, is a 52% decline. That places it within the range of mid-cycle corrections in prior Bitcoin bull markets. It is painful. It is structurally significant, but it has not yet approached the 75% to 80% drawdowns that characterize prior cycle endings. What history does not do is guarantee a specific resolution, but it does provide a question worth sitting with. If Bitcoin has survived multiple 70% to 80% drawdowns, multiple exchange collapses, a global pandemic, aggressive central bank tightening, and multiple waves of Bitcoin is dead coverage, and the protocol continued mining blocks, settling transactions, and maintaining its supply schedule through all of it, what would a genuine structural failure actually look like? Because it would look different from what we are currently observing. What we are observing is cyclical pain. Structural failure looks different. The macro monetary context is the water Bitcoin swims in, and right now that water is neither fully supportive nor fully hostile. It is ambiguous, and markets hate ambiguity more than they hate bad news. The Federal Reserve's benchmark rate currently sits in the 3.5% to 3.75% range, cut down from peaks above 5% in 2025. Jerome Powell has described current rates as within a neutral range. M2 money supply in the United States sits above $22 trillion, roughly 4 times its level 2 decades ago. The Fed's balance sheet sits around $6.6 trillion, having peaked near $9 trillion during COVID stimulus. Before 2008, it was below $1 trillion. Against that backdrop of monetary expansion, Bitcoin's supply schedule remains fixed. Approximately 19.99 million Bitcoin are currently in circulation. After the April 2024 halving, new supply enters the system at roughly 450 coins per day, approximately 160,000 per year. That supply constraint does not change based on macro conditions. It does not respond to rate decisions or geopolitical events. It is governed by code and mathematics that operate indifferently to human sentiment. There is also a supply milestone approaching that will receive significant attention. Analysts project that the 20 millionth Bitcoin will be mined in March 2026. After that event, just 5% of Bitcoin's total supply will remain to be issued, ever. Not this cycle, ever. That mathematical reality does not move price in the short term, but it provides the structural scarcity context within which all price discussion ultimately occurs. On the regulatory front, the Digital Asset Market Structure Bill, so discussed at White House-hosted meetings this week, represents a potential clarity catalyst whose significance most retail participants are underestimating. Formal regulatory classification of Bitcoin as a digital commodity under CFTC oversight would unlock allocation pipelines currently closed by regulatory ambiguity. Pension funds, endowments, family offices operating under regulatory constraints, that door begins to open. Regulatory clarity does not produce immediate price fireworks. It produces structural demand shifts that compound over months and years. 3 forward scenarios built on current data rather than wishful thinking. The first, gradual stabilization and recovery. The Warsh nomination, uncertainty resolves without fundamentally changing the forward rate path. ETF outflows, which have already slowed from their peak weekly rate of $1.7 billion to $315.8 million last week, continue decelerating and eventually reverse. The on-chain accumulation by retail holders establishes a demand floor. Whale category wallets, seeing Bitcoin consolidate in the $60,000 to $70,000 range for an extended period, begin rebuilding positions. The market structure bill advances. The 20 millionth Bitcoin milestone generates media attention that reframes the scarcity narrative for a new audience. Recovery in this scenario is not explosive. It is methodical, frustrating, and structurally sound. The people positioned through the consolidation benefit from the full range of what follows. The second, extended correction with potential for lower prices. Standard Chartered published analysis this month projecting Bitcoin could reach $50,000 before establishing a true cycle bottom. If October 2025 marked the cycle peak, historical post-peak bottom timelines would put a potential low anywhere from now through mid to late 2026. In this scenario, Bitcoin grinds lower or sideways for longer than the market's patience can sustain. The retail buyers who accumulated at $65,000 to $70,000 grow frustrated, sell. Institutional participants who have been reducing exposure continue to do so. The clearing takes longer and goes deeper than current sentiment suggests is likely. This scenario does not break Bitcoin's fundamental structure. It breaks the patience of a meaningful percentage of current holders, leaving them positioned on the sidelines when conditions eventually shift. The third, the macro wildcard. US-Iran tensions that CoinDesk noted as looming over risky assets this week de-escalate faster than expected. The Warsh nomination either fails confirmation or his policy stance proves more moderate in practice than in reputation. Global liquidity conditions improve more quickly than priced. The market structure bill passes with stronger bipartisan support than anticipated. In this scenario, the same mechanical forces that amplified the decline, forced selling, liquidation cascades, systematic risk reduction, reverse with equal speed. Institutional positions get rebuilt. Short sellers, who have been accumulating puts at steep premiums, cover those positions. Price moves before consensus feels safe enough to re-enter. The people who were positioned through the fear period find themselves in front of a move that rewarded endurance rather than prediction. None of these scenarios is certain. That is not a disclaimer. That is the actual structure of reality in a complex adaptive system. Now let's talk about what is happening in your mind, because the most expensive mistakes in this market are not made in the market. They are made in the 6 inches between your ears. Recency bias is the cognitive error that makes the most recent price experience feel like the most probable future state. When Bitcoin was above $100,000 in January, recency bias made continuation feel like analysis. It was not analysis. Today, with Bitcoin at 68,381, recency bias makes further decline feel inevitable. It is the same error operating in the opposite direction. Markets are architecturally structured to punish this bias at the worst possible moments. The most painful point, the point where selling feels most rational, is systematically the point closest to the turn. Loss aversion runs deeper than recency bias because it is biological rather than psychological. Research consistently demonstrates that losses create approximately twice the emotional impact of equivalent gains. A $50,000 move down from $126,000 does not feel like the mathematical inverse of a $50,000 move up. It feels categorically worse. That asymmetry means that as a position moves against you, the emotional pressure to eliminate the source of that pain grows faster than rational calculation would suggest. At some point, the pain of continuing to hold exceeds the capacity of the framework you entered with. The decision gets made not by the analytical brain that did the research. It gets made by the limbic system that simply wants the discomfort to stop. Think of compressed spring mechanics. The more pressure applied to a spring, the longer the compression, the greater the force, the more energy stored in that compression. The spring does not announce its release. It does not give advance notice. It releases when the constraint is removed, and the release is disproportionate to what the compressed state suggested was possible. The period of maximum market compression, maximum fear, maximum selling pressure, maximum narrative negativity, tends to be the period that contains the most stored energy. The people sitting closest to the spring when it releases benefit from the release. The people who stepped away to avoid the discomfort of the compression miss it entirely. The panic loop is the final mechanism worth naming explicitly. Price falls, fear increases, checking frequency increases, exposure to negative data points and negative commentary increases, fear increases further, the felt need for action increases, a decision gets considered that would never have been considered from a calm state. The loop is self-reinforcing. More information during a panic loop makes the loop worse, not better. The antidote is not more data. The antidote is a pre-established framework built during a calm state that removes real-time emotional decision authority from the equation. So where does this leave you today on February 22nd, 2026? Bitcoin's protocol is functioning normally. The network is processing transactions, mining blocks, and maintaining its supply schedule exactly as designed. Circulating supply is 19.99 million coins. Daily new issuance is approximately 450 Bitcoin. The halving has happened. The ETF infrastructure exists. The institutional custody layer exists. The corporate treasury adoption strategy holding 77,131 Bitcoin at an average cost of 76,027, buying more at 67,610 per coin this month even with their position underwater, exists. None of that reversed because price fell 52% from its high. What reversed was the macro and psychological environment around it. And macro environments change. Psychological environments change faster. The question that actually matters is not where Bitcoin trades next week. Nobody can answer that with integrity. The question is whether the thesis you entered with, the reason you bought, has been invalidated by events or only by price movement. Those are different things. Price movement is not thesis invalidation. Price movement is volatility, and volatility was always part of the asset's character. Thesis invalidation would look like the supply cap changing, like institutional infrastructure dismantling, like regulatory elimination of custodied access, like the halving mechanic failing. None of those things happened. What happened is that Bitcoin fell more than 50% from a peak while maintaining every structural characteristic that constituted the original thesis. That is painful. It is not the same as being wrong. Before you close this video, I want to leave you with the only question that actually matters for long-term positioning. If Bitcoin is trading at a meaningfully higher price 18 months from now, what will you wish you had understood differently about this specific moment? Not what price you wish you had bought at, not what trade you wish you had made. What you wish you had understood about the difference between structural reality and cyclical pain. That answer, your honest answer to that question right now, might be the most valuable piece of analysis available to you in this entire market environment. Next time, we are going to go deep into the regulatory mechanics, specifically what the Digital Asset Market Structure Bill being discussed at the White House this week actually means for institutional capital allocation, and why the details of that legislation matter far more than most crypto coverage suggests. That conversation will fundamentally change how you read regulatory news in this market. Stay analytical, stay structured, and stay honest about the difference between what the data says and what your emotions are telling you it means. This is not financial advice. Bitcoin is a volatile asset. It can fall further from current levels. Position sizing, time horizon, and risk management are not secondary considerations. They are the primary framework within which everything else operates. Understand your own financial situation before making any investment decision.